The Fed's about to break something. They're about to really break something. And when they do, when the Fed breaks something in the economy, it will signal one of the biggest opportunities for asset markets to make a meaningful reversal. So let's dive into some new information. And this was information from Darius Dale, who is one of the best macro analysts out there. And he's going to explain how the Fed is trying to cram over 2 years of quantitative tightening on top of everything we've experienced already into the next 6 months. And he believes that in the process, it's mathematically impossible that the Fed doesn't break something. Now, what does that mean? We're going to break this down after the clip, but I want to show you this clip right now and then explain its significance, because once the Fed does break something, it's going to be one of the biggest opportunities for all asset markets and probably all investment markets since the COVID crash and the ensuing wild amount of free money printing and the up-only economy that followed. Let's go ahead and dissect this clip right now.
Our math suggests we could see over $900 billion of net liquidity drained from now through year end. That's bigger than the entire drainage of net liquidity we saw in the sort of 21 months between, kind of mid 17 and mid 2019 as a function of the previous quantitative tightening program.
Now, of course, $900 billion, if you're doing your maths correctly, is at this point bigger than the entire crypto ecosystem. Actually, let me just check that. We've been hovering around $1 trillion. Yeah, the total global market caps for crypto right now are $938 billion. And we all know that you can't actually extract a full $938 billion from the crypto markets, because if you were to start selling, those market caps would start going down exponentially. So just know, more than even a theoretical amount of money in crypto in every single asset class will be removed from the global economy here in the next 6 months, is what Darius Dale is trying to say here. And the hole goes deeper than that.
So we're trying to squeeze more than 21 months of QT in through the pipe in like 6 months. The Fed will break something. I'm convinced about that. I think it's pretty clear at this point they're going to break something if they try to do that. Because again, the markets don't know how to digest that removal, the size of that removal of liquidity at such a truncated period of time. And it's our expectation that that's going to cause some problems this fall.
And so what you need to understand is it's not just more money going away. They're actually going to break something in the economy. And this might mean that just like in 2008, where actual banks blew up and the credit markets blew up, or this might mean that emerging economies completely blow up because other countries aren't able to keep up with the relative strength of the dollar and they can't pay back their dollar-denominated debts. Just look at the Eurozone and the EU, and the euro is crumbling in the face of a very strong dollar in these macroeconomic conditions. At a certain level, the Fed has made it clear they only care about sticky inflation, and inflation is measured against goods and services, not against other fiat currencies, right? So we know inflation, the CPI, is wildly high. The Fed has made it very clear that politically and otherwise, they only care about controlling that inflation, that goods and services inflation, and that they don't care about a recession, and that they seemingly don't care about breaking asset markets or any other markets. So what you need to understand, though, is that nothing has broken, and the Fed has been tough talk and really not flinching. But once something breaks, that changes everything. It changes the entire game if the treasury markets break and all of a sudden they're not able to control the yield curve on the US Treasuries market. We're going to talk about all this in a second, but first you need to hear a little bit of a dose of unfortunate news about what this means for the short term, because this is where it actually affects our precious crypto bag. So listen to this part and then we'll dissect it all at the end.
What are the biggest losers when that happens?
Go to the riskiest part of the spectrum. If you look at the spectrum of risks, and those are the things that get destroyed. When liquidity dries up, it dries up in the fringes first, and it just keeps drying up and takes one asset class after another until eventually it's getting close to your beloved S&P 500.
Now, of course, this clip was courtesy of The Best Business Show, which is, of course, run by Anthony Pompliano. Go check him out. Great show over there. And their discovery here of Darius Dale and bringing Darius to the crypto community has been an absolutely epic contribution. But what, of course, did Darius just say? Well, he said that when this happens, of course, which are the assets that are hurt first by liquidity drying up? The reality is here that it's going to come for the riskiest asset classes, and we know that means cryptocurrency. So as this liquidity is drained over the next 6 months, if the Fed is able to keep keep removing this liquidity without breaking something, it's first going to come and it's going to impact cryptocurrencies, NFTs, the things that are far out on the risk spectrum that only really flourish in an extremely risk-on environment, and then it takes out other asset classes along the way. Now, we know the Fed isn't going to be bailing out cryptocurrency anytime soon, which is the sad part, but it's also the good part because crypto has real price discovery. That means that when these devastating lows do get put in, this will be an opportunity of a lifetime, because in the end, if Darius is right, and he's been right literally all year long, since the Fed pivot in November, he's called it absolutely perfectly. And if he continues to be right here, it means that we're going to see something real break. And when that happens, it'll be a black swan-esque event that will take a significant chunk out of mainstream markets and more than a pound of flesh out of crypto. And in doing so, I believe that will form the real macro bottom of this cycle, and we'll start to see the Fed blink here. And once we start seeing the Fed blink and starting to care about something other than sticky inflation, which hopefully we start seeing come down a little bit soon, the reality is that we can start seeing a return of asset markets. Even though inflation is a very scary, perpetual sticky inflation of the dollar is a very scary concept, the reality is that the Fed will have to step in and start intervening and changing their policy at some point if something breaks, something like the credits markets, or more specifically, the treasuries market, which looks like it could be subject to yield curve control in the not too distant future. What does that mean? Well, we broke it down on a previous episode called The Doom Loop, where we go into the theory made popular by Arthur Hayes about how eventually the US government will have to forcibly keep the interest rates of treasury notes low by printing money and buying them. And in doing that, by implementing yield curve control, the theory is that risk markets and Bitcoin in specific end up going absolutely parabolic and reaching over $1 million in value. Now, if and when that happens, whatever these tragic lows of the market might be in the long term, it will eventually turn into a wild runaway bull market for risk assets that are being bet against the dollar, especially Bitcoin, which many macro analysts believe is the best play from a monetary debasement standpoint in a risk-on environment. So what does it mean? It means that if the Fed breaks something, it's going to form probably one of the best buying opportunities and investment opportunities in our lifetimes, maybe ever, because this pivot might be one that they can't unpivot from. This might be something that becomes a permanent fixture of quantitative easing going forward, and hopefully by that time, inflation isn't so bad. But the reality is that the Fed is between a rock and a hard place, trying to control inflation while staring down the barrel of a brutal recession and trying to effectively hit the political hot buttons first and foremost, and not really being so successful in doing that so far. So in the end, I think it's more pain for crypto in the short term. And this has nothing to do with crypto, the promise of NFTs, user behaviors. And as we look into the future of the metaverse, which is no question it's going to happen, then the question is really, who's going to not believe in this stuff? Who's going to be totally sidelined as the new pivot from the Fed brings yet another round, and potentially the strongest round yet, of risk market appreciation and asset market appreciation. Until then, though, the best policy is just to sit on your hands, because I bet your bottom dollar people didn't see this bullishness in the market coming after the CPI print. The days of easy shorting this market down from the top are over, and people who use leverage and are too aggressive in trading will get blown up and chopped out of this market, unless you're an absolute GOAT trader like Crown. I shouted him out yesterday, and I will say Crown and I are really good friends. I absolutely love that dude, and he's an amazing trader. But I've also seen that very few people can trade the market like he can in these difficult conditions. Not everyone can do this. In fact, very few can, and most people are going to lose their butts trying to trade the different moves of the market. It's not an easy time to trade, but what I am looking for is that black swan moment where the Fed truly breaks something, and all of a sudden they're forced to blink, change their position, and all of a sudden the fastest horse to lose value during the Fed pivot into quantitative tightening will now be the fastest horse to gain value. And that's when crypto, NFTs, and other assets in this wild world are going to start being some of the biggest darlings of the investment community once again. But remember, people have lost so much faith in this industry. It will still be a very controversial bet. And those contrarian controversial bets that end up paying out are always the biggest, of course, extremely risky. And I hope this entire bear market has helped you all learn how to manage your risk just a little bit. Maybe there's some lessons you've learned. I certainly hope so. The reality is that there is a huge moment coming up. I don't know when it's going to happen, but if the Fed breaks something, it's going to spell out an absolute monstrous opportunity, and I'll be here to cover it, because this is not the kind of stuff that happens every day. We're living through history, and history always presents some magnificent opportunities in investable markets. As always, if you enjoyed this, smash that like button. I'm EllioTrades. You can find me on Twitter at EllioTrades. If you guys are looking for an amazing crypto exchange, make sure you sign up for FTX and check out our Intro to Crypto series with FTX. They're my exchange of choice. Of course, I want to be very clear. You should never leave a lot of money on any exchange, even a great one like FTX. But if you're looking to get in and out of crypto, into fiat, or start dollar cost averaging, they are by far my favorite option. You can check them out with the link below, and there's some juicy discounts if you sign up with that link. As always, my name is EllioTrades, and I'll see you very soon on the next episode.